Let's get to Bob Pisani, who joins us now and can tell us more about what is this significant rotation going on, at least today, Bob.
Yeah, 3 days, actually. Now, this would be the third day. We got that value rotation. Of course, what's value? Value is essentially cyclical names. They're bank stocks, they're energy stocks, they're industrial stocks. To a certain extent, they're material names. And that's exactly what's happening again today. If you take a look at the sectors, banks, energy, industrials leading. Techs are lagging. Interestingly, Jim mentioned biotech's been weak now for a couple weeks, essentially. Not doing much on top of that. Mega cap tech, yeah, another day of weakness here. Some of them are starting to show a little technical weakness. Microsoft, for example, Facebook, so 6-7% below their recent highs. So that's starting to get a little bit of attention here. As for where we are, we're knocking on the door of new highs here. We mentioned that before. 7 days in a row, S&P is up. We'll see if we can make it 8. But the February 19th closing high, 33.86. See if we can push through that. But again, we've got this little value rotation. Don't kid yourself, though, in terms of what's really mattering. Since that February 19th high, it's technology, folks, and it's clearly technology. Now, consumer discretionary is up a little bit only because Amazon has been huge. But ex-Amazon out, everything else is pretty flat. Communication services up a little bit. Google's kind of flattish. Healthcare, a small contribution. But all those things we get excited about, mega cap tech is really the stuff that's mattered here. I know the last few days they've been down, but your Amazons, your Apples, your Facebooks, your Netflix, your Microsoft, look at this. Since the February 19th high, this is what has pushed us to new highs. And I know we're all excited about the value rotation 3 days in a row, but when you actually look at the value stocks since the old high, the old February 19th high, you take a look at industrials and banks in particular, and energy stocks, you can put those up. Well, folks, they're lagging. I know they're rallying the last few days, but let's keep it in perspective. What's really moving things is clearly tech, clearly semiconductors, clearly software overall. We'll see if this little mini rally that we've had in value stocks is going to continue. Meantime, another rally still, not just in stocks, we're getting rallies in junk bonds. HYG is the largest junk bond ETF. That's been up. And David mentioned this earlier about the junk bond rally. Ball Corp is an aluminum can maker. Now, they had an offering, which is nothing unusual. They raised $1.3 billion in a 10-year bond. Again, nothing unusual there. Here's what's got everybody's eyebrows raised. 2.875. This is a junk bond offering. This is double B plus, just below investment grade. There are reports this is the lowest borrowing cost ever for a 10-year junk bond. I haven't confirmed that, but that makes a lot of sense to me. I think what's going on here, David, is there's essentially no high yield in high yield anymore. And a lot of people explain this very simply. They say that the Federal Reserve, this is one of the downsides of the stimulus, has essentially ring-fenced a lot of high-yield companies that may have had default problems in a normal environment in this kind of situation, this kind of recession. And the Fed stimulus and other kinds of stimulus are essentially ring-fencing a lot of these weaker companies, leading to very confident pricing in some of these high-yield bonds.